what I wanted to talk about was what's going on in the housing market because all the headlines are super negative. So I'm not an economist, and all the charts I'm about to show you I grabbed off the internet, so you can find them yourselves. But there's some interesting data out there if you look beyond the headlines. So, Jeremy, you want to go to the first page here, or the next page? Do I need to advance this? Yeah. Okay. So these are the headlines. You guys have seen them from all sorts of major news sources. What a crazy year! I didn't put the headlines from the beginning, but I'm sure you remember in Q1 there's a inventory shortage of homes. Every house has got 20 offers. They're all cash. Everyone's scrambling to buy houses and waiving conditions, and it was all sorts of stories about how the builders have underbuilt for years and created these supply shortages, and now suddenly everybody wanted to leave cities after COVID and move to a house somewhere. Obviously, those were trends that were going on before COVID. People moving into lower cost areas, states that have lower income taxes, like Florida, are more business friendly, and leaving higher cost areas. That wasn't new. Maybe it just accelerated and got more attention. Now we get later in the year as the Fed's raising interest rates, and it's the exact opposite. Oh my God, the housing market's crashing. It's terrible. Nobody can afford a house. So that's what these headlines are. So we want to look at some of the statistics behind that. What's actually going on? Want to go to the next slide, Jeremy? So here's one we grabbed off of realtor.com, and I think this is interesting. So this is showing listing. So what are the listings that are going on? And it's showing it over a multi-year span. So those lines at the top are 2017, 18, and 19. And you can see, and in case you didn't already know, there's a seasonality to housing. Listings, start increasing at the beginning of the year and then peak, and then they always come down this time of year. Anyway, usually people don't want to move over the holidays. Also, a lot of people want to move when their kids are not in school. So there's a seasonality every year. So that's not a surprise. But then you look at that middle line, well, that's 2020. Well, of course, COVID, it was harder to show houses, so no surprise. Fewer people were listing their homes. They didn't want a bunch of strangers traipsing through their houses. But that downward trend continued. So those two bottom lines, that's 2021 and 2022. So what was going on then? Well, now we had a housing market that was heating up, and people who didn't need to move were suddenly worried that if I list my house, I may be homeless. Like no problem finding a buyer, but if I want to downsize, if I'm not a cash buyer, since it seems like everyone is, what could I do? And we actually had clients in this situation where otherwise they wouldn't have needed our program. Mike described our typical client, which is someone who doesn't yet currently qualify for a mortgage. We act as a kind of bridge and help them get there. But we also had people coming to us earlier this year that were just saying, I want to downsize. My lender's telling me, hey, no problem. You got great credit. You can get a loan, but your debt to income doesn't support two homes. So as soon as you sell your current house, I can get you a mortgage for your new house. Well, if you're worried that you're not going to be able to get that offer on your new house accepted, you're not going to move. So we saw listings decline. That continued into this year. Now we get into a situation. I threw a little statistic at the bottom there. It's this little sentence I grabbed from a story in April, and there's probably a more current one. But as of April, Redfin reported that 51% of people who have mortgages in the U.S., their rate is 4% or less. That was a decent rate at the beginning of the year, but now, my God, who's going to voluntarily? And there's maybe a quarter of them are 3% or less. So who's voluntarily going to give that up? So the headline has been no one can afford to move into a new house, but the real headline should be nobody could afford to move. But right now, the market is saying these 7% mortgages, and although the headlines are it's going to be 8, 9, 10%, that's not what the investor is saying. What the mortgage servicing market is saying is we don't see these 7% mortgages staying outstanding for very long. So people may take those mortgages on now, but they're going to refi. It's actually very easy to refi once you're already in a home. For example, if you do FHA, they have something called Streamline. You don't even have to re-verify your income. You just need to be current on your mortgage. So anyone who's locking in this high rate now will probably be refinancing as soon as rates come in. So if, looking at that prior chart, right now, treasuries below 4%, we get back to a more normal spread instead of 300 basis points of, let's call it 200 basis points. It's not hard to make the case that mortgage rates could come in considerably in in the first quarter of next year, even without there being some big action by the Fed. Basically, as soon as the market feels like the inflation picture is stabilized, which doesn't mean rates stop going up. I mean, as Powell said, they're probably going to keep raising rates. They're going to keep them up there. But we know the market's a great discounting mechanism. Treasuries are going to react not based on Fed funds, but in anticipation of inflation. The market feels like inflation is coming under control. If anything, treasuries are going to come down. Those mortgage buyers are going to come back. The mortgage spread is going to come into a more normal rate that we've seen over the past couple of decades. So you're not going to get a 3% mortgage, but is it off the table that you get a 5.5% mortgage? Maybe you will. Let's go on to the next slide. So I think mortgage rates are going to come down. It's a long-winded way of saying that. So this one is, so who's buying houses besides the individual? So the individual right now may be in shock because the payment's gone up so much. And again, we've all seen that headline. $300,000 house at the beginning of the year, your payment was X, and now it's 50% more. And so, and house prices are coming down. So, why would I want to buy in that market if I feel like house prices are coming down and my payment is so much higher? But the other thing that's different in the market today versus the past is a lot more homes are going to investors. This whole asset class of single family rentals as an investment really sprung from the financial crisis in 08 and 09. And it started as a trade. These companies, American Home for Rents, Invitation Homes, they didn't start out as a business. The view historically was you couldn't professionally manage a large scale SFR empire. It would be inefficient. Much better to do multifamily. Multifamily has been favored by investors for much, much longer. And so when investors ran out to the courthouse steps when all these homes were being foreclosed to buy houses, they didn't really think they were starting a business. They just thought they were buying cheap assets. They'd resell them and move on. But in fact, businesses were born out of that. Now that these businesses exist and you have these companies that have 10,000, 25,000, 50,000, I think Invitation Homes has 80,000 houses. These companies are not going away. They're not stopping buying houses. They may be buying fewer. And so the headline is, sharp drop in these investor purchases. But look at the absolute level of activity versus historically, there's still a huge percentage of this diminished U.S. housing inventory that has been and continues to be sucked up by investors. And I'm not saying that's a good thing or a bad thing, but it is a fact of life. So if this is a good time to buy housing, why are those guys sitting on the sidelines? I mean, they know a lot more than me. They got a lot more money than we have. Well, why are they slowing down? To propel a large-scale SFR business, the difference between very large, medium, is not who can buy houses cheaper. We compete with these guys when we're buying houses in Atlanta who've got billion-dollar balance sheets. The seller doesn't care. If you've got enough cash to buy their house, whether you've got enough to buy 1,000 more behind it, doesn't matter to them. So having a lot of money is not a competitive advantage. Are you more efficient in operating that house once you buy it? Again, and this is where these companies start to differentiate themselves with investors. Who does better on turn times? Who does better on maintenance costs? These are hard things to differentiate yourself on. The real differentiator is who has the lowest cost of capital, because these are levered businesses. These loans are being securitized. And when they were being securitized and these big guys are paying, 2 and change percent for borrowing, the fact that a cap rate on an SFR was 4 to 6%, well, that was still a positive carry trade. But now, securitization market largely shut down. Again, just as we said, the demand for mortgages went down, demand for a lot of fixed income went down because people said, shoot, I don't want to own low coupon fixed income in a rising rate environment. I know I'm going to lose principal. So it got much harder even for the biggest players to get any type of securitization done. And the rates blew out considerably. And so for them, but the cap rates on homes have not blown out. So for them to buy a lot of houses at these prices, it's probably negative carry for them, meaning they're just betting on appreciation. So of course they've tempered. It makes sense for them to temper their growth or temper their pace of acquisition and kind of revisit next year. So what happens then? That might be my last slide on this. Is there another one? What's next, Jeremy? Yeah, the sales pitch for Dream America starts next. So the So what does all this mean though? If we just think about this, these sort of high level statistics, the individual homeowner or home buyer is sitting on the sidelines at the moment, seasonally, and also because they're in shock over rates. Whether you believe this idea that I threw out a case that maybe mortgage rates are going to come in or not, whether they come down, which I think they will, or not, people will start to forget 3%, like it's gone. And now the landlord's knocking on my door, raising my rent, and I'm back to that decision, which is, do I buy at current, do I buy at current prices and current rates, or do I wait? And I think more and more of those home buyers are going to come back to the market. They've been scared away by all these headlines and the higher payments, but as they absorb that, the fundamental desire to own a home, I don't think, has gone away. It's something we never have to sell to clients that come to us. They've already decided owning is better than renting, if for no other reason than my payment doesn't go up every year. Like, I control my payment. If I don't sell my house, I know what my payment is. Whereas when I'm renting, I never know. Is my rent going up each year? Is the landlord telling me he decided to sell the house and I have to move? There's a lot of uncertainty uh, in that. So those buyers are going to come back, and the investors are going to come back as the market gets its head around that. Which we already see the stock market, rallying on some of the Powell news. As the stock market and bond market decide that inflation is under control, they're going to quickly start discounting what's next. Securitization market will be reopening for these big guys, and the big guys are going to be back out on the market too. They didn't go away, but they'll be picking up their pace, and they're all going to be coming back to the same market that we're in now, which is inventory is low. So that's why I think this is actually a good time to buy a house. And people said, oh, but what if prices are falling? That's going to hurt you. And of course, we're not immune, as no one is, prices going down. But because there's a kind of a buyer's strike right now, you don't have to wait till next year for this calamity to unfold to get a discount. You can get it right now. We're getting it right now. You go out into Atlanta. We just did it. We give a client a budget of 250. This is an actual example. Of course, they want a higher budget. Budgets today are lower because payments are higher. We're using the same math as everyone else. People's income and other payments, like their car payment, is going to determine their housing budget. There's no magic to cracking that code. We give someone a 250 budget. The house that I want, this is what they say to us, they always say this to us, is 300. So we talk to the realtor and we say, just go out, show them $300,000 houses and submit 250 offers. Now you can imagine what most sellers' response is to that. It's not good, but we're not here to represent sellers. We're here to represent our investors and our clients. And after they went through 6 houses, eventually somebody said, fine, but I'm keeping the washer and dryer. Our standard offer says we get the appliances. So that was it. They got the washer and dryer. And we literally bought a house for 250. We closed on it last week, where the guy a month before closed next door at 330. That guy's pissed. We just ruined the comps in the neighborhood. But these opportunities do exist. Now, maybe if you're one of these giant SFR companies, you're trying to hoover up 10,000 houses, you can't do what I'm talking about. But when I'm looking at it as as us, as a small fund manager or as an individual, you can go out and you can find those opportunities now. If you're coming in as a cash buyer, which we are, and we close in 2 weeks, we don't waive inspections. We do inspections, we do appraisals, we do everything that we need to do, but we do it quickly. And right now, there's a dearth of cash buyers. All those cash buyers we were fighting with in Q1, all the big companies, right now it seems like they're gone. When we show up, there might be another offer from someone with a mortgage contingency, but we're bringing certainty to the process. So that's the overall. I'll take some questions, but I've got a few points here I'm just going to give you real quick. So in case it's not clear, versus our strategy versus a rental. So you might say, great, Chris, thanks for the information. I'm just going to go buy a rental house on my own. And you could certainly do that. And it's something I grew up with. My parents did that. They didn't invest in the stock market. They invested in rental houses. It could be a great way to build wealth. The advantage that we have from our system of converting our tenants into homeowners versus a landlord is, one, we get a higher rent. So I said 4 to 6 cap rate that you might get on a rental. We get a 9. Now we give a piece of that. We give 10% of the rent we've collected back to our clients when they buy. But our conversation with the client isn't, could I rent this house for less? The conversation with the client is, do they believe Dream America can help them become a homeowner? Because they don't plan on renting from us long term. It's a 1-year lease. They can buy. They can cancel the lease at any time when they buy. So we're getting a premium rent. We collect a 1% fee up front. And if we buy a house today, we start collecting rent today. That is not what you would do on your own, and that's not what the big boys do. They go out and they buy lots of empty houses, then they rehab them. So they got rehab costs, they have vacancy costs, then they have to lease them, so they're paying a leasing commission, and then finally they get a tenant after, whatever, however many months of vacancy. And if they're lucky, at the end of the year, that tenant renews. If not, they got to incur all those costs again to turn the property over. For us, standard, somebody moves in today, we start collecting rent today. We are not involved in the routine maintenance items. Our clients are dealing with a home warranty company, similar to what a new homeowner does. So they're not calling us for a leak under the sink. There's a big issue like a tree falls on the roof, something that's an insurance issue. Obviously, we get involved. We have lower maintenance costs than an SFR. And then in our standard scenario, at some point, whether it's during the lease, at the end of the lease, in the second year of the lease, not everybody buys in the first year, we sell that house directly to the tenant. So we've never had a day of vacancy. We've never spent any money on maintenance. And we're not paying any brokerage commission when we sell the house. It's a direct transaction between Dream America and the tenant. So all of those benefits ultimately then accrue to our clients. Go to the next slide here, Jeremy. And so what that means, you can see here, we've purchased just over 50 million of houses over the past few years. And on our sales, our investors have realized an average net annualized return of 26%. And that's, net of fees and expenses. So excuse me? Yeah, so our leverage during this period, our LTV has been around 55%. So, oh, yes. Yeah. So that's the levered return. Our unlevered return, when we add a new house to the portfolio, a 1-year return target would be 14%, cash on cash, which if you've been investing in real estate, that's a high number. To hit those kind of numbers, you need to take a risk profile that's totally different than us, which is real estate development. We're not, again, we're buying an asset today that's cash flowing today. The 14 is based upon 9+ is coming from the rent, 1% is coming from the upfront fee, and then the balance is coming from home price appreciation. So if the home price doesn't appreciate, and that's a good question, something investors say, well, what happens? Well, then we're in the same position as anybody who bought a rental home. We're not forced to sell the house at a loss to the tenant, and we won't. They would have to continue to rent that home, and we just would wind up with a longer duration. As you can see here, our duration on our sales has been just over a year. So this is also, as real estate investments go, it's been a relatively short duration. In a downturn where people are unable to buy, or there's more, job loss, recession scenario, obviously our duration is going to extend. Homes that we're focusing on tend to be median price homes. So we don't operate in Miami. We like to operate in markets where if you earn a median income, you can afford a median home. Unfortunately, that's not Miami. We're based here, but we can't solve affordability with our product. We operate in markets like Atlanta or Jacksonville or Tampa, where people can still buy a median price home.
You mentioned, I don't know if you have time for a little.
Yeah, go ahead.
In the beginning of the presentation, you mentioned that your business model was that of bridge lender to buyers that do not qualify for a loan.
Mm-hmm.
What would be the process of that individual then acquiring the property? In other words, you're basically a private lender.
We're like a lender, but we own the asset.
True.
So it's I describe it as a bridge to an FHA or VA loan.
Correct.
So what we're doing is saying, what do you need to do to get a mortgage? And can we help you do that over the course of 12 months? If the answer is yes, you're a candidate for our program. If the answer is no, we're going to say work on something and come back in the future. And so if, sorry, what was the balance of the question?
So if you are a bridge, say you are a bridge lender, not to talk down the cement.
Yeah.
Obviously, the exit strategy for you is clear. You give the individual time to qualify for a loan, then he replies you, and that's how you get your money. What is your rate in that? Because obviously you're a short-term, say, private mortgage lender.
Mm-hmm.
What are your rates for that individual, and how long, in your experience, has that individual taken in order to refi?
Yeah, so the average you can see has been just over a year, but the distribution's all over the place. So some people are a few months. That's an anomaly. Some people are a couple of years. So we underwrite with a 1-year time horizon. But if people don't follow the plan that we've given them, 1 can turn into 2, could turn into 3, could turn into never. Some people never buy from us. And the rate that we're charging them is the rent, and that's a cap rate that's close to 10% currently. So we price the rent as a premium to mortgages because we want it to be an incentive for people to refi, that when we show them to a lender, the lender says, oh, you're going to save $200 a month when you buy. You already live in the house. You've given us the down payment. So that's another advantage we have versus a landlord. We're collecting 3% or more. So we've got 4 or 5 months of rent if you default. It's much different than 1 month security deposit. We're going to give that back to you when you buy. So we've created every incentive within the program to get people to buy as quickly as possible because we want them to stick to the plan and turn it over. Yeah.
You referenced that your portfolio sits at about 55% levered.
Yeah.
Right?
Yeah.
So you're securitizing the assets post acquisition of these residents that are moving in?
We actually do it at the time that we close.
You do it at the time of close?
Yeah. So although I say we're a cash buyer, all that a cash buyer means is you don't have a financing contingency. Right? Anyone could say they're a cash buyer. Now, of course, when you say you're a cash buyer, the seller says, show me proof of funds.
So
But
who ends up being legal on the holder? Is it a bank that you're
yeah, so we have a line of credit with a bank we deal with in Georgia, and then we've also done one-off rental financing on properties, which are securitized loans. We're not doing those currently for the things that I talked about in the securitization market. That's why I know a little bit about what's going on in the securitization market, because all of a sudden the lender we're working with there, the terms get worse, and I talk to them and why, and here's what's going on. But yeah, we also have a committed revolving line of credit, and the reason that our leverage has been on the low side is because of the turnover in the portfolio, right? Because if you just went out and bought an asset, like I said, I'm going to go buy an apartment building, you'd probably get a higher LTV at that moment in time. For us with the line of credit, we're always kind of turning stuff over, so we're always sitting on some cash.
You mentioned the bank in Georgia. What's the geographic concentration of the CDOs?
Yes, so we currently offer the program in major metro areas in Florida, Georgia, and Texas. About 2/3 of our houses are in Atlanta. So Atlanta is a key market. So lease to own, we didn't really get into this, but it's an area with limited competition. But the big player is Home Partners, who Blackstone bought last year. They've got 17,000 houses, so we don't have the space to ourselves. But ultimately, it's not a story about competition because the demand for this far outstrips the few people that do it. But Atlanta is Home Partners' #1 market, so it doesn't surprise me that it wasn't like we set out to make it our #1 market. It's also, if you look at FHA and VA loan volume, that's a big FHA VA market, and we're really feeding into that. So any market where there's FHA VA is where we can go.
I know we're about to fly a bit, but Florida, is it South Florida or is it much Orlando Central?
No, in Florida, I was mentioning earlier, it's not Miami. It is Jacksonville, Tampa, and Orlando. Unfortunately, Miami is just not affordable. So we need the people who come to us are, truck drivers, nurses, people who are earning a median income. And unfortunately, if you earn a median income in Miami, it's going to be very hard to buy a house. Good. Okay. All right. Thanks.